Hello, welcome back to this week's market update. Today is Monday, April 14th, 2025, and we'll jump right in. Stocks rallied last week as President Trump rolled back many of the new tariffs that he had announced in the week prior. So you can see a huge jump on Wednesday last week in markets, leading the Nasdaq Composite up 7.3% higher for the week, the S&P 500 up 5.7% on the week, the Dow Jones Industrial Average up just shy of 5%, while yields rose, driving the Barclays Aggregate Bond Index down about 2.4% last week. Taking a look at the tariff rollback a little bit further, it was announced via Truth Social on the president's page last week, where he actually increased the tariff charge to Chinese imports to 125%. Two countries continuing to negotiate and go back and forth with additional reciprocal tariffs last week. So that is still in limbo as of Monday today. On the other hand, though, he said that over 75 countries had called the US in order to start negotiations, which led to this 90-day pause and a substantially lower reciprocal tariff of 10% effective immediately as of the 9th last week on Wednesday. You can see the market's reaction to this news. This was about 1 o'clock on Wednesday last week, and stocks just shot up with the Nasdaq Composite up more than 12%, the S&P 500 up 9.5%, the Dow Jones Industrial Average also up almost 8% there, and then the Barclays Aggregate Bond Index pretty much flat on the news. Although the week was very overshadowed by the change in tariff policy, there was a few other notable economic data points, such as the CPI, the PPI, as well as consumer sentiment released last week. Overall, we saw inflation data come in better than expected, with the CPI cooling to 2.4% compared to a year ago, and core CPI at 2.8%. Headline prices actually fell 0.1% month over month in March here, while core prices rose a very small 0.1%. You can see by category, we had 2.4% grocery inflation, so on pace with the total index. Energy prices falling was a huge source of this negative month over month inflation, with energy as a whole falling 2.4% in March, down about 3.3% from a year ago. Other categories like shelter, we saw a bit of a slower pace of inflation with about a 4% annual inflation rate. Still high, still pretty sticky, but it is lower than it has been in previous months. Transportation services also fell pretty sharply, and that also has to do with the decline in energy prices. So you can see that fell 1.4% month over month. So overall, a pretty positive CPI, and we'll take a look at the trend in the next slide. Looking at the longer term trend in CPI, you can see we have been moving lower in the last 2 months or so. We are in this trend since 2022 of lower inflation, although we do remain above 2%. So initially we had some concerns that the headline CPI especially was rising in recent months, really since about August, September of last year. It had been rising into the new year, but you can see February and March's data did show that inflation was slowing. So that's a good sign there. Now the question is, will it continue to slow towards the 2% target, or will we see some tariffs and other economic factors flow into some higher inflation later on this year? Additionally, with the CPI, we also got the PPI, the Producer Price Index, also known as wholesale inflation. This came in better than expected as well at 2.7% compared to a year ago, so a pretty big drop from the previous month. And then core PPI, which excludes food, energy, and trade, a little bit stickier, but still improved at 3.4% on an annual rate. On a month-over-month basis, we saw headline prices actually fall for producers about 0.4%, while core prices rose about 0.1% in the month. A lot of the decline was due to falling goods prices. You can see 0.9% goods prices fell in the month of March, mostly led by a decline in energy prices, down 4% in the month, as well as a decline in food prices. They're down 2.1% in the month, and a lot of that was driven by a 36% decline in egg prices, which ultimately led to these better wholesale inflation numbers. Last but not least, we also got the University of Michigan's Consumer Sentiment Index, continuing its slide in April, falling for the fourth consecutive month, about 11% lower than it was in March, largely across all demographic groups, across ages, incomes, educations, regions, and political affiliations. So a lot of consumers are concerned over the state of the economy in this survey. Since the recent peak in December of 2024, we are down about 30% in consumer sentiment. A lot of this having to do with the tariffs and their potential economic impact. So, about down to the same level as the bottom that we made in 2022. If we continue on this path, it is looking like a recession indicator. However, we could see a bounce back depending on how the economy and how markets move in the coming weeks. So you can see we did bounce back from that in 2022. But one bearish indicator here, we do have the highest level of consumers expecting rising in unemployment since 2009. So you can see that has skyrocketed here to about 67% of consumers expecting unemployment to rise. This has been trending up for 5 straight months, and we are near the same levels that it was at during the financial crisis of 2008 and 2009. So a bit of a warning signal there, but not necessarily, concrete truth, because we do know that these things are just one indicator of the many, many economic data points that we take a look at on a regular basis. That concludes this week's market update. We had a very full week, a lot of economic data, better than expected inflation, as well as a unexpected rollback in that new tariff policy. But we do see some areas of weakness like consumer sentiment. So very interesting week. We really appreciate you tuning in, and we look forward to seeing you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.